Hello and welcome to ABC News. I'm Ros Childs. Australia's economic recovery appears to be further strengthening with a stronger than anticipated bounce in inflation in the December quarter. Consumer prices rose 0.9% in the December quarter, and that took the annual rate up to also 0.9%. Here's our finance reporter Alicia Barry to explain more. Hi Alicia, so much stronger than expected reading on inflation, but what does that tell us about how the economy is travelling?
Well, we have now seen 2 quarters in a row of price growth. So this is a consumer price inflation index. It's a basket of goods which measures the prices. But basically what it's telling us is activity in the economy is reasonably strong. Consumers are out spending at the shops. We know that the retailers have seen record retail figures. People aren't able to travel overseas or take really expensive offshore holidays. They are contained to their states in many cases. So they're spending on things at home. We saw household goods in the inflation survey, one of the strongest performers, along with tobacco and other sort of household items really driving the survey. It means that the economy is recovering, I suppose, relatively well. If you've got a job or you're in a sector where you've received a lot of government stimulus and support, then we're seeing those areas do particularly well. Those consumers are out spending. So basically it's just showing us that activity is ticking along quite nicely. The inflation rate, though, is still well below the RBA's target band of 2 to 3%. So a 0.9% reading on an annual basis is quite low. However, there is a risk because of this consumer activity that inflation could pick up faster and sooner than the RBA is forecasting. It's anticipating that inflation will be quite low, well out to 2022, and has made quite explicit statements saying that interest rates won't rise for around 3 years. The risk to that is inflation rising. Now, I spoke with the chief economist of EY, Jo Masters, a short time ago, and she says that over the short term there is a risk that inflation could bounce back sooner and faster than the RBA is forecasting, but over the long term things are likely to be fairly subdued.
My own view is that in the near term we could see inflation accelerate faster than we're expecting because we've got this pent-up demand and still some dislocation of supply chains. But in a longer term sense, we still know that wage growth is the #1 driver of inflation. There's plenty of spare capacity in the labour market, and wage growth expected to be very, very weak. So I don't think we're going to see inflation surge higher in any long-term or sustainable manner.
How have the markets reacted to this?
Well, the Australian dollar is usually the first to react to economic data, and particularly when it comes to inflation, because it's normally a pointer to interest rates. It did pick up off the back of this stronger than expected number, as I suppose traders might reassess their interest rates expectations, although let's remember that it's still well below the target band that the RBA is looking for with that 2 to 3%. It did jump a little against the greenback at 75.5 US cents, and worth noting that the greenback is also quite weak at the moment, because traders overseas are expecting that the US government will roll out more stimulus measures, or the US Fed will also contribute when it announces its policy decision on Thursday. When we turn to the broader Australian share market, it's been performing a little weaker as we return from the Australia Day public holiday. The mining and energy stocks are the worst performers today, dragging down the broader market. The All Ords and the ASX 200 index are currently down a little over 0.5% each. Volatility offshore was adding to nerves, and the world's largest fund manager, BlackRock, has warned companies that fail to plan slashing carbon emissions to net zero are facing steep cuts in their valuations. And that is the latest in finance news for now, Ros.
Thanks, Alicia.